Are the struggling global markets finally starting to affect the United States? Keep watching to find out more about this topic and also what happened in the markets last week.
All of the major U.S. markets were down last week, with the S&P 500 down around 1%, the Dow Jones down about 0.2%, and the Russell and the NASDAQ down 1.5% and 2.5%. All these indexes are still positive for the year. Foreign and emerging markets were both down around 3% last week, and foreign markets now down almost 5% for the year, while emerging down almost 10%. The chart that we're looking at today is of the Global Equity Index. And this index consists of 70 countries, and of these 70 countries, 23 of them are developed nations, which include the United States. Now, Matt asked a question at the beginning of the video. Are the global markets starting to affect the US markets? And I'm going to touch on exactly what he meant when he asked that question in a minute. If you look at the black line on the chart, that's simply been the performance of the global equities since 2000. And you can see since 2009, the global equities have been on an uptrend, and this is mainly because of the performance of the United States markets. But I don't want to spend too much time looking at the black line. I want to focus more on the red line below. This line shows the percentage of these countries that are above their 200-day moving average. Now, I've mentioned and talked about the 200-day moving average before, but just to reiterate, the 200-day moving average is a key level that we look at to feel if we are bullish or bearish. So as you can see at the far right of the red line, currently there's only about 30% of these 70 countries that are above their 200-day moving average. This has been led by the US markets, which are, again, positive for the year, but this means that about 70% of the world markets are in bearish territory. This 30% level is important because we've seen a similar level happen in 2006, 2010, 2011, 12, and 2014. And each of these times we've seen a sharp bounce to about 80% of the countries in this index above their 200-day moving average. So if this happens and we see a bounce here, this could be something to be extremely bullish about. Now on the flip side, if we cross down below this 30% and even more countries go below their 200-day moving average, we could see something similar to 2009 where there were 0%, and that means 0 countries in the global equity index above their 200-day moving average, and this could be a very bearish signal for the overall global market.
Last week, August job numbers came out, and the economy added over 200,000 jobs and also showed that we have the largest wage growth since 2009. Lastly, trade negotiations between the United States and China are at a standstill, and the $200 billion in tariffs that was proposed months ago is going to be going into effect here shortly. This week we have a lot of key economic data reports coming out, including on Thursday, inflation, and Friday, retail sales.
Also, outside the domestic news, we're paying close attention to the foreign and emerging markets, hoping that we see a rebound into the remainder of the year.
Thank you for watching, and we strive to give you everything that you need to know about the markets in 5 minutes or less.
Like our Facebook page and share our video. Thanks a lot, and we'll talk to you guys next week.